Yo, how we doing, guys? Let's see if this is all up and running. Boom. How are we? Cool. Here we go. Right, so someone let me know that this is working so I can see the chat box. If someone says hello, that'd be lovely. Otherwise, we're just going to get straight into it because we are recording, we are streaming. So on the agenda tonight, obviously we've got Trader XO here, who's a mate of mine. We've been mates for a long time, even though I was away from crypto for about 4 years. And what we're going to do tonight, same as every Monday, we're going to run through Bitcoin, Ethereum, and Solana. And we are going to have a few minutes uninterrupted each so we can both talk about our analysis, see how we got the same levels, and discuss just different ways of how we get to those levels, basically. I look at price action, XO looks at price action, and then also market profile. So it's a nice little combination, basically. And then we're going to get into some other stuff. We're going to look at when the crypto bottom, where we both think that's going to be, how it's going to look. And then a few questions on trading, which I'm curious about. I like to make these streams something where I can learn from other traders. That's kind of why I'm doing these streams. And the subject I want to talk about is automated trading versus manual trading. And automated trading is something I'm going to be starting to look at later on this year, probably. And I know XO is doing that pretty well and diving deep into that. And then last of all, we're going to have a trader psychology subject, which is going to be about a pro trader mindset and what it takes to kind of be consistent as a trader and what kind of mindset is needed for that. So I'm going to run into it now and introduce him. And basically we're going to get straight into it and just look at the chart work. And then we will crack on with everything as quickly as possible. So hello, mate. How are you?
Hey, man. I'm good. Thank you. Yourself?
Yeah, very good. Very good. Cheers. Once all these technical problems keep kind of cropping up. Right. So I'm going to run straight into this. I don't need to introduce you. Everyone knows you. Most of my followers are your followers. So I'm just going to run into my thoughts on Bitcoin, and then I'll hand it over to you, and then we'll look at your thoughts on Bitcoin, and then we'll do Ethereum, then Solana, and then we'll go from there. Okay, mate?
Absolutely. Sounds good.
Lovely. Right. So I'm going to start with Bitcoin on the hourly time frame. And I've got all of these levels from my video this morning, so I'm not going to redraw them because it'll take ages. So I'm just going to explain a few things, and then to obviously the audience, but also so you can see my trail of thought. I'm going to start off really simply. We had a downtrend here. This is hit resistance at this point, which I haven't drawn on the chart at the moment, but we have this downtrend, and then sitting at the lows of this downtrend, we have this supply zone, which is where the sell-off originated from to create this low. And then what happened was price comes up, breaks that supply zone, creates this level here, and then kind of bounces off the top of it and pushes all the way up here to create this new high. And then we have, if I just get rid of these lines, this high here, and then the one just below it, we have what I call a decision point. This is just basically a demand zone. It's where the buying took place for price to push up, and then it gets retested. And if this trend is going to be sustained, this level is going to bounce price. We're going to see higher highs, but it doesn't. It breaks it. And then on the break of it, we get this lovely supply zone where we get two lower lows form on this trend, breaking also this key level. If this level holds, the market structure at this point is bullish, in my opinion, on this time frame, because this is basically where the origin of this entire swing is from. Once it breaks it, as we tend to get in crypto these days, it follows legacy market rules, like the market law, where it breaks a key level and always retraces to another point rather than just continuing, which is what a lot of crypto people are probably used to. So it comes back up and then it puts in a really clean range at this point at that key supply zone. If it breaks this supply zone, the market structure changes again. From bearish, we're bearish because we've taken out this key level, and we start looking for longs on this time frame. It ranges, breaks it once, tests the high, tests the very extreme of that supply zone, and then breaks down with strength. And this is where I went short. And then it's come all the way down here and created a new low. So it's taken out this retrace point, which isn't a significant level. People would look at this as support, but for me, it's engulfed the level, it's broken it, and then it's a retrace point. On a revisit of it, you're not going to go and like bet your house on that because it's just like a weak area. It's nothing really significant. And then we have this low here as well, where we are currently seeing price ranging, and it is come down with strength, tries to push up, and then over the weekend drops back down, and then at the open wicks it, and then I've woken up this morning, it's sent it all the way back up here. For me, I know at this point, this is just like weekly open shenanigans, and it should be dropping back down here and sending. So on this time frame, what I'm looking for is just for the range low to be broken with some strength, and then look for that to continue to the downside. And then jumping on M15, this is the little level we quickly spoke about before we jumped on stream. We've got the break of the demand zone, and then at that demand zone, we have a key supply zone. I've just marked the extreme of it, MPL, max pain level, if you remember how I do these things, because I always think the extreme, the level is going to get hit, but we have a very clear impulse down, and then we have the level. So in this instance, this is a clean level on its own. It's not a reaction to anything. If it was up here, maybe it would be a reaction from here, and then I'll be looking a little bit higher for price to move up to. But what it's done is it's pushed down below this range low, comes back up to this supply zone, and then it's painted a really nice range here. And then what it's done is it's made the range like so, pushes up at this point, fakes the high, wicks the high, and then comes all the way back down, hits the high again, and now has made a lower low. And I'm expecting this to drop now. So if I'm not in a trade already, that's a short that I could take. Or what I would then wait and see if I'm not in one is for it to come down and then range again at this low. And then I'd look for the same, just a couple of continuation signs that it's going to head lower. And then my target for this next move would be about 62K at these range lows. I think we'd get a bit of turbulence there, but from a higher time frame perspective, we've tested these lows multiple times. We've put in two major pushes to the upside. We've got a higher low, and now we've got lower lows. So I think the next time it comes down here, it's going to send a lot lower to 52K, which is kind of my target for this down move, basically, on this time frame. So yeah, that's me with Bitcoin. I'm just going to send over to your screen now and then see what you're thinking.
Yeah, fab stuff. It's very fascinating. I think we, in fact, you and I have been very aligned since October, November in our thoughts on Bitcoin from the highs all the way to current price action. I don't think this really comes as a surprise to us. I think maybe what surprised us was the speed at which we saw Bitcoin go from 125 down to 60K right in early February. I think I would have expected it to not quite dropped to that level at that pace, but there we are here, so, but overall, I think if I just share my screen, I don't know if the users can see that.
I've got you on trading view at the moment.
Yeah, all right, brilliant. Cool. So I think I've attested to in previous streams where, all this current price action here, I think you have to remember that when one is looking for longs, it's very easy to assume, oh, look, in terms of local structure, price is making a higher high and another higher high here, and therefore this must be really bullish. But really, if you look at the higher time frame context, you've got to understand that the weekly trajectory is still on the way down, and as is the 3-day. So you really have to, be cognizant of the higher time frame view of Bitcoin and what the structure is of Bitcoin, because it's very easy to get carried away when we see price breaking out of a local range high, just as we did back in January, and the same happened again, more towards the middle part of March. Now, I think if one thing that stands out for me, it would be the fact that, well, looking at price action here, if I just go back to the weekly time frame, and this is something that I alluded to very, very early, is that it wouldn't surprise me. In fact, this is what I was leaning towards as my base case, that we actually get this environment for the next 6, 7, 8 weeks where we just gravitate between a very choppy local range where there's not really much happening. There's no real initiation to go higher. There's no real initiation to go much lower down. And I think every time we test the lows here, it was, the sentiment was fairly bearish. And every time we started pushing up, I wouldn't say euphoria, but there was a level of high optimism that this is now going to go back up to 90K. And I think we're just in that similar environment. Structurally, when we come down, we filled in the inefficiency down to this base. And I think once again, when I look at what the immediate support level, this is actually the mid of this entire high time frame range. So it wouldn't surprise me if we come down to that level. Now, if I just switch over to kind of the market profile chart, what's interesting to me is, which really aligns with what you're saying, is that I still think and I still believe that February's range is going to be key, and I'm looking to trade the inflection point. That's February's high, and then we've got February's low. And what stands out for me the most is that if this is February's monthly profile, and you can see the value area, what is the value area? The value area is often 68, or in some cases 70%, as to where time or where price has spent the most time. So you can see price throughout February spent the majority of its time between 71K and this support level or value area low at 65K. When you look at the market profile for this month, which is almost coming to an end, we've got one more day tomorrow. Again, the value area has pretty much been contained almost within the previous month's value area of 72K, 71.5, down to where we are currently today, around about that 67, 66K level. But what's interesting and what really makes me think that we could really move low down for that 60K level, well, if we start trading through this value area low, not only is it February's value area low, we're probably going to take out these these poor lows in terms of whenever that's been formed. But I think the minute, as you said, once we kind of consolidate and get compression, I think that's where we see potentially continuation. And what that means, in my opinion, is that when you zoom into the charts here, even on let's just go for the 4-hour time frame, I think it's just going to be a case of, well, what's going to cause price to accelerate? And I think it's going to be a case of, if these are the poor lows here, or these are the resting lows, you're going to get a build-up of positioning, inventory where positions are building to the long side, and they're still very optimistic. But the minute you will start pushing through these levels is when you start seeing cascading of, not necessarily a cascading of liquidations, which could happen, but also people being taken out or traders being taken out of their positions. So what does that mean? Long buyers, or those who are prospectively long, are now becoming forced sellers, which kind of accelerates the move down. And you can see that there's really not a great deal down until the 60, 61, 62K level, which again is February's low, and that's February's high. And that for me is the range that I'm looking to trade. And again, the reason why I talk about the fact that I wouldn't be surprised again to see very similar price action to this, where look, we keep testing the highs, we just can't seem to break above, we go again, we can't break above. So what do? We drop inside the range and go to the other side of the range. And then we'll have to see whether this is compression that breaks down. I don't think we're anywhere remotely close to resolving this level. And if we do, then great. That's going to be a pickup in volatility. And that's certainly something that I'm going to be looking to trade. So that's kind of pretty much my high time frame hypothesis, low time frame levels that I'm looking at. I think 65, like you summed up the trade setup, I think that's the one to look for. Below 65, barring a stop run, we could see a move lower down to 60, 61, 62.
Yeah, I'm just going to jump onto my screen again on the weekly time frame. I don't know if you remember my concept of max pain level. Essentially, and it's really clean. Like, one of the reasons I love crypto is it actually trades really cleanly. When there's volume in it, it's an absolute dream. If we've got this weekly demand zone, if you've got, your typical rally base rally as a demand zone, and you've got an uptrend like this, when it's pushing up hard and it retraces back to these levels, it normally hits the top of them, which is what it's done here, and then tries to make a new high. Well, it makes new highs, but it can't sustain the trend. So what it does when it comes back to find liquidity is it's going to come back to the origin of this move, essentially. And instead of bouncing off the top of it, it's going to come this time down to the extreme of it, called max pain level. It's where, if you're looking long, it's max pain, because if it breaks that level, it's going to hit your stop loss. And if it breaks it, it's also going to change the market structure, and the trend's going to continue to the downside. So when I've seen all of this, and I've been quite consistently calling for about 52K, even though I don't think it's the bottom, I think this is where this trend is absolutely heading. And I've marked it like this. This is what I would call max pain. It's the absolute limit of that level, and it's moving quite nicely where it's come into the demand zone, but it's now failing. And I think this is essentially where it's going to head down to, and it kind of lines up with what you were just saying as well, which is pretty clean, like pretty nice. But yeah, if you've got nothing to add, let's jump over to Ethereum now, chapter 2.
Absolutely. Yeah.
Cool. All right. So again, I'm just gonna. This is my plan from this morning. Basically, I had two plans, which I'll talk about now. So we were up here this morning, and I said what I want to see is price to come down within this range again, and then exactly the same as what we've seen in Bitcoin. Put some lower lows in, and look for some continuation signs to the downside. I'd also said that I would like it to come up to this supply zone. So the picture I've painted is it's really similar to Bitcoin, that it comes up to essentially this supply zone, which I don't really like, because this is what I would consider the whole level. The entire chain looks like that, and then we've got the impulse away from that chain around here. So bearing in mind what I just said about max pain level, when it's a very choppy market like this, I don't want to look for a shallow short. I want to go as deep into this level as possible. And this level I consider as a reaction to this level up here. So ideally, I want to see the shorts come up there. That's where I want to enter. But in this instance, it's kind of, as you can see, ripped all the way up to it and then created a lower low from there. So it just indicates to me that the market is weak as fuck. And at this point, obviously, we've hit these lows. We've got the uptrend. We have this high here, which again was another resistance level here, which had been holding us down for best part of a month. I'm just marking that to make it easier. So price hits the level, drops, and I'm thinking, right, this should be the moment now where it continues, but it doesn't. It picks up the strength, comes up, and then creates this level here, which again is what I call a decision point, where the decision was made to push up above this level rather than respect it, and then ultimately head up to this supply zone. And then we got a really nice short opportunity that built here, where it breaks down, it ranges, and then it's either going to push up and continue the trend, or it's going to break down from here. And obviously we can see what had happened. Comes down to this decision point, and instead of bouncing and respecting the trend, it ranges, it breaks down, respects the underside of the range, and then drops. But this is the level for me where this entire bit of price action originates from, because we had this downtrend after hitting this supply zone, breaks out of it, creates this demand. You got a typical, again, rally-based rally, continues up from there. And this trend just comes down into it, but bounces. I mean, in the laws of supply and demand, you can see, like, right, okay, it's obvious that you would expect buys from this level. And people will say, well, this was when I think they called for peace talks with Iran, and that's what caused it. But, news always tends to line up with these levels. But the key tell was that it failed to push above this high here. It puts in equal highs and also a really clean range, at this supply zone. I've marked it as a range, but it's technically a supply zone, you know, whatever you want to call it. Pushes up, breaks down to give the signal of intent, and then pushes back up to sucker people in, because a lot of people are getting bullish at this point. And you can see it wicks it really cleanly and then just collapses through. And this is where we got short again. And now has dropped down to this origin level and starts ranging. And then we've got two key levels at this point. So we have the range itself at that demand, which is key, because if this trend is going to go, it should be breaking down here. But what it's done overnight, obviously, it's taken the liquidity out. It's faked down. If you were watching this live, you would have been getting pretty horny that this is going to drop. But then it just rips back up straight into this supply zone. And it's the inverse of this level here. It's the decision point. It's where the decision was made to come down and break this low. So above this level, the market structure changes because the trend is no longer intact. And then you start looking for longs intra-week. But so far it's respected it. And what I would expect now is for it to come down and then start creating some lower lows, some lower highs, and some momentum to the downside to look for short continuations. But again, if we look down to M15, which is a really solid time frame, I find, for day trading crypto, it's not the cleanest of ranges, but if you just kind of mark something out with your eyeballs like this, you can see it's pushed up, dropped down below, and then what I'd want to see is another push up that fails, and then a lower low with some strength below this one, and then you've got a short opportunity to take down. Or you wait for it to come down either to the range high or come down to the range low, and then you would look for a continuation sign that it's just going to go. And my continuation signs are, it will break the level once, come back up, and then break the level again. Sometimes, depending on the environment and how strong the trend is, I want to see it a third time. But that's how I'd be looking to trade this if I don't get that last high and then a lower low. But otherwise, I'm happy sitting in the trade I'm in, to be honest, this week. But that's kind of how I'm seeing Ethereum. I think everything still looks pretty bearish, and this doesn't look like an organic push to the upside where it's going to then break levels and keep trending. It looks like a fake move, in my opinion. So yeah, let's jump onto your chart and see what you've got.
Yeah, great. Lower time frame take. I think I would have been certainly interested in trading Ethereum. And, you know, in Q4, I took over 120 trades. In Q1 of 2026, I've taken probably 11 trades over a 3-month period. I think, you know, the time for me where I was aggressively short in the market alongside you was October, November, December, January. And I've really taken my foot off the pedal now because I feel like I don't want to get too caught up on the lower time frames or intraday trading here. This is a stage in the market where, you know, I think we're going to see a lot of pessimism, and there's obviously geopolitical takes, and, you know, there's bearish sentiment. I think the further down we go, the greater the value, perceived value. So I'm really looking at this from a higher time frame perspective, where sometimes I think to myself, you know, when I look at the market here, you know, I could intraday or intra-week trade this, but there's nothing really exciting happening. We're just in a compressed range, and we have been. So that would really force me to trade lower down on the 5 or the 15-minute chart at the absolute maximum 1 hour. I don't believe I've got a great edge. It's not something that I really fancy doing. So yeah, I'm not really getting any intra-week setups either. And so when I look at the high time frames, you can see where we've rejected according to the 12, 25 weekly moving average, which I'm a big proponent. And for me, we're at the key range quarter. I think, again, if we lose that 65K level on Bitcoin, you can certainly say for certain that Ethereum is probably going to take out its February lows to begin with, and maybe we get an extension into 1500s. You know, whether that leads to an increase in volatility that I can range, and whether we carve out a range lower down, that would be something that I might consider trading. But from a high time frame perspective, What I'm really looking for is a shift, a massive structural shift, and that's base building, and that's a shift on the high time frame bands to give me a reason to start trading momentum. Yes, I could trade the range. I think there are far better assets to trade the range on, like Bitcoin, but Ethereum is one of those where I'd much rather trade a pretty much a good market cycle or a market trend. And I don't think we're going to come out of this anytime soon. Yes, we could see a sharp rally. That sharp rally could be a move down, taking up February's low, and we may see an aggressive bounce, just like we did, over here back in 2022, a drop to the lows and a really aggressive rally from 1100 straight to 2000. So that's a fairly decent move. It's a fairly significant move. So I'm really waiting for those extreme sell-offs or extreme positioning where there's a lot of aggression selling into the lows, but price can't seem to go lower down. That's often an indication that there's enough level of absorption or buyers showing interest there. And currently what we've seen on the market, there's clearly not enough demand to push the market higher. In fact, there's more interest in sellers stepping in to push the market lower down. So unfortunately, I don't really have too much to add on Ethereum. I think, again, it's just one of those charts where if it looks like a bigger range, trades like a bigger range, it probably is a bigger range. And if you look at the highs here, where did we drop to? We pretty much dropped to around about, from 5,000 down to 23. There's the drop base second leg down. So again, is this that second leg down, just like we got from A to B? I think you can't rule it out, is what I would say. It's not a certainty, but it wouldn't surprise me. Is it something that I want to trade? I probably don't want to look for high time frame swing shorts. Any trades that I take would probably have to be on the lower time frame. Just get in, get out. We're in a very tough predicament with markets where any headline is going to kind of run your positions over if you're on the wrong side of the trade. So, it is going to be somewhat news driven movements, I feel. But overall, the high time frame structure remains king. And so if there was an opportunity to sell, then for me, it's selling from a mean revision back into the bands for lower prices.
Yeah, you made some good points actually about particularly the sentiment as well. I think a lot of people are now sort of cotton on to the fact that we're in a bear market and they're doing it after prices dropped. Well, in Ethereum's case, nearly $3,000, and people are going, oh, maybe we should short this thing. And I tend to think what happens then is that price does kind of have another impulse down. But in terms of a higher time frame trade, you wouldn't really, the risk reward is decreasing quite rapidly now as we're getting closer to a bottom. And it's normally those people that come in late that end up providing the liquidity needed to fund a bottom, if you like. But yeah, I don't really like trading Ethereum. I don't think it's very clean. Lower time frame is okay at the moment. It looks all right, but on this higher time frame, it looks pretty garbage, to be honest, doesn't it?
Yeah, I think when you look at this previous range, I think if we start dropping into there, I think we go to this range bound environment here. I think we go to this mid level. Just take it from one zone to the next. My ideal optimal zone, I'd love to buy something down there. Whether we get there, again, I don't know what's going to happen in terms of price. And as a trader, all I can do is focus on, all right, what are the potential zones that are attractive? One, as a trader, and two, as a potential buyer of Ethereum. I think Ethereum is going to get a lot of flack, or Ethereum's a bag of shit. It doesn't do much. It never did much. But I still always believe late cycle, it moves fairly well, just like it did in from April through to August. That was a fairly good move, from 1,500 to nearly 5,000. And I think at some point in the near future, well, not in the near future, maybe in several years' time, I think we will get a breakout of this 5,000 level and probably trade up in 7.5, 8 maybe. But I think I'm talking more from a cyclical perspective. So for that reason, I always would like to retain just some level of exposure to Ethereum, and especially if it's going to be at the lower bounds of the range. Mm-hmm. Brilliant. I'd love to see that, to start thinking about building a position. And then once we get a shift in momentum with the bands, that's where I'll start trading it on perps and really amping up the size on my spot plays, looking to compound into what has been already a winning position. It's kind of playing the backside of the V. There's your, a lot of people enjoy dollar cost averaging down, and then they kind of get shaken out at the bottom, and that's your capitulation low. And then this is what I want to trade, the shifting structure, the crossover in the moving averages. We're nowhere near that right now. So, this is more of the environment that I want. Slow momentum and accelerate. So slow momentum, that leads into acceleration.
Yeah, agreed. Yeah, very nice. Right, let's jump onto Solana, get that out of the way.
Sure.
Then talk about someone wrote on the on X, like, I hope it's not just lines and charts all stream, and it's not going to be, but let's get this bit out of the way because people do want that and I like talking about it. So H1 on Solana, this for me has had a really nice picture again. I think out of all of the three coins, Solana's traded so nicely. So if we just have the daily time frame just to start with, just to show you something. So we've got these two outer lines here. Let me just remove these and then put them there. We have a really clean range that has formed, and it's tried to break out, and it's coming right back down to the lows, and it's coming with strength. But if you look here, we've got 1, 2, 3, 4, 5, 6, 7, 8 candles to get up there. And this has basically gone from the top of the range to the bottom of the range in about 4. So I think, you know, when you see these small candles, you don't want to really get bullish on that. So if we just jump back down to H1, so we have the picture a bit cleaner. We have here, this is that first push up out of that range. And then this is all very similar to Bitcoin and Ethereum because they're just mimicking each other. We have the trend up. We have this point, which is the decision point to put this high in. Again, if this is a bullish chart, this is going to bounce off of support and send us higher, but it doesn't. It breaks through it and then creates this supply zone. That's the whole zone. And then if I just put max pain level, because that one makes it a lot neater, and you can see it always kind of gravitates up towards the extreme of the level. And then again, what it's done is it puts in a range at the supply, bounces off of this support zone, comes up, hits the high, signal of intent, where it's telling us that it wants to go down, but not yet, comes back right up to the high of the range. And the really key thing here for me was that it broke above it, puts a high in, retraces, and then puts a second high in. So it's got 2 higher highs, and then just completely falls to the bottom of the range and then breaks that range low. And it's done it with strength. And that's where I entered a trade. And I put this public as well when it was building, and then it just completely shits itself. And if we just look over to the left, we've got this big low here. There was resistance up here, which I haven't marked. We've got a downtrend similar to Ethereum, and this is the retrace point. And what happens is it retraces out of that downtrend and puts in this demand zone, pushes up, retests it, and puts in another high. But all of that liquidity is being tapped, and it comes all the way back down to the extreme of it, bounces. Again, this was like that Trump pump and peace talks, whatever. But why does that happen at key demand? And then fails to push up and then breaks down. So we're obviously bearish. And in these instances, a lot of people get really horny online and people get really excited, but you've got to anyone who's listening, if you've got a bearish bias, you've got to wait and sit through these moves and look for the exhaustion, in my opinion. So what it's done now is taken out that key demand. It's taken out this retrace low with a little bit of a liquidity grab, and it's retraced at this range that has built between the two levels. It's not my ideal level, but the volume is really high, and we're in a pretty strong downtrend after, on the daily time frame, having multiple, like 5, 6, 7 attempts to push up, and now it's broken down with strength. So this looks fair game for a quicker continuation, in my opinion. I don't normally like to look for quicker continuations because I like to see a retrace to a key level, like what we saw on Ethereum. But in this case, it's just breaking down. So on this time frame, I want to see it break the range low one more time, which is probably going to be enough of a signal to go short. But I've noticed with Solana, what it does, it will give a couple of signs that it wants to drop, and then it will come all the way back up, similar to like this bit here. And then it drops and puts the move in. So I'm being cautious of that. On M15, I just sent to my subscribers, like just before we jumped on the call, that we've got a range that has formed. And similar to what we were just saying on Bitcoin, you've got at the break of this demand on this time frame, you've got this supply zone. Instead of bouncing at demand, it breaks through it, and it's at the bottom of this impulsive candle. So it's kind of its own structure in its own right. breaks the level and retraces all the way to the beginning of the structure, paints this range, and now has dropped through it. So what I would like to see ideally, if I wanted to get into another position, is just one more test of this range and then another breakdown, and then look to short that. And my higher time frame target with Solana is about $50 for this move. I don't think that's the bottom, but we'll talk about that shortly. But certainly for this move, I'm aiming for about $50. And I think this may be, if it ends up taking these lows, if it ends up creating a lower low on this time frame, we're going to start taking out the range low here, and then I think it's going to sink. So yeah, that's kind of where I'm at on Solana. I'm still bearish on everything. It's kind of like what you were saying earlier. We're at the tail end of the bear market now, and I put in my video this morning that you normally get a 6 to 9 months period for a bear market or for a bearish trend, and then you get the base that builds, and then you get sort of the impulse away to the upside where we can start thinking about a bullish trend. And we're getting closer to that bottom, but there are still pretty good opportunities. But for those that are trading higher time frame, then yeah, there aren't as many opportunities because the risk reward isn't there. But I'm still finding quite a lot of nice setups intra-week, which are pretty cool. So yeah, that's me on Solana. Let's jump over to your screen again.
Yeah, I think that fab comments, fab thoughts there shared, and I think I align with you there. Again, I just have to say vocally that I can understand the bearish sentiment. For me, the time to short this from a swing perspective was months ago. This is now where I think intraday, intra-week, fine. But again, my attention is shifting more towards a higher time frame. What's important for me is that this previous range where in 2022 we sold off aggressively, we saw a level of bullish divergence, for those of us who like to use the RSI, but look at where the market sold off from. It was that 145, 150 level, okay? Exactly where the market sold off from here. In January, comes back for the retest in March, straight through back down to the side of the range and continuation. Well, what's capping price? What was holding the market up in this instance? You can see, look at the wicks. Okay, it's evidently clear where sellers are stepping into the market. One final retest runs the highs into that key zone of that 143 to 150 level. And look how quickly the market sold off in February. Consolidating now at the mid of this entire range. And again, I think it's this base for me, Matt. If we take out February's low, I think, look, simple formula. If Bitcoin takes out its February's low, Solana's at 83. I don't see why we can't trade that $50 to $60 level. And there we might get a reaction. And in terms of reaction, I'd be looking for this type of structure here, where we may get a one drive and then two, 1, 2, and then a final third push before we get a sharp, bear market rally, just like we did here. Then it's a question of, all right, is this the low end? Are we going to start building a base here, or is this just continuation? Is this more of a drop, another base before we see continuation low down? I can't tell you the answer. I don't think anybody has got the answer for that. But certainly in terms of recency, in terms of inflection point, again, everything for me comes back down to, as a high time frame inflection point trader, February's low becomes of interest. Now, because the trend is to the downside, right, it doesn't necessarily mean, oh, look, we've traded February's low. Exo said he wants to buy. No, I did not say I want to buy February's low, because as a trader, if I'm going to hit February's low blindly, I'm pissing against the wind. Look at the overall moving average. When has that ever worked out well when price is going down? The three things that you want to think about is, when you're using a system very similar to mine on a higher time frame context, is look at the trajectory of the bands, look at the velocity, look at the momentum. This is not something that you want to stand against or try to trade against. Number two, look at the displacement between the bands. Okay, look at the distance between the bands. This environment, okay, is not something where you want to be on the wrong side. You just want to sit back. If you don't want to buy the market, if you don't want to short the market, and you don't want to jump in too early because you don't really have the conviction, that's fine. You can wait for the bands to compress. You can allow for price to form a range. And look at this, from where we established a low in June 2022 at $31 all the way through to October 2023. That was, in effect, 15, 16 months of price action. Very, very low volume, very small candles at the lower bound of the zone. These are the signs that I'm looking for to potentially see, all right, I think the market's sellers are exhausted. The market's not really doing a great deal. We're going sideways. The bands are compressing. This, once we get the breakout, is more attractive in terms of looking for longs aggressively as a trader. Okay, whereas this environment is more just range bound rotational price action here. I think this is setting up for continuation. The only question is, and I really like the scenario that you marked, because I think if we do get one more push up and it's a lower high as to what you've mapped out back into the 12 band on the weekly, I think that sets up for a nice short. Or if we get a push up into February's high confluent with the 1221, the upper bound of the bands, I think the minute we lose that, it's a sell all the way down to the other side. So it's a question of, do we get it back up first to trade February's high? Is this going to be a lower high, which we can sell into February's low? Or, are we just going to drop straight down from here, which I probably won't entertain as a trader?
Yeah, very nicely said. I'm hoping that it just drops. If it goes back up, I think a lot of people are fatigued with all the ranging and all the sideways and all the false hope. I just want to see it sink to the bottom. But let's move on, actually. Just keep Solana up, but let's move on to the next section, which is a crypto bottom, and just kind of get your thoughts. We'll do this very quickly on where you think BTC, ETH, and Solana will drop to. I've sold, I'm out of crypto completely, so I'll talk about where I want to look to buy as well. But I'll let you go first for all three, and then I'll do all three. And I'm sure they'll probably line up, because we've had conversations where we can see that maybe 30 to 40K on Bitcoin. Although we're not saying it, we don't see that as an impossibility. Let me just jump onto my screen.
Yeah, I was going to say, I think in all honesty, where is the Bitcoin bottom? I don't know. I don't know what level, what price. I think it really depends on geopolitical factors. And if you look at equities and NASDAQ, they don't look particularly great. I'm sure we're going to see some, short coverings over the next week or so, which is probably going to give some sort of market reaction if there is one. But overall, the one thing I will say is that when Bitcoin trades through its 50 weekly moving average, it doesn't take much thereafter for Bitcoin to trade straight to the 200 or the 300 weekly moving average, which has quite often proven in previous cycles to be more or less the bottom. And in the 2015 cycle, when we broke through the 50 weekly moving average, we went straight to the 200 and formed the bottom. In 2018, we broke through the 50, went straight to the 200 and bottomed out at 31s. In 2020, COVID crash, we traded through the 50 and we almost tagged the 300. 2022, we lost the 50 straight down to the 200, through the 200, through the 300, and eventually bottomed at the 350 weekly moving average. So I think, once again, if price for me, honestly, comes anywhere between the 2 to 3 to 400 weekly moving average, and let's just say, worst case scenario, if it is a recession, then who knows where the bottom is. But ultimately, that's not something that I'm really contemplating as a trader. I don't really get too caught up in the macro political factors, because I think there's always going to be long opportunities. There's always going to be short opportunities. But as an investor, one thing I do know is quite often that if I do see seller exhaustion into the 200, 300, or 400 weekly moving average, I'll certainly be looking for a slowdown in selling momentum and some sort of base building to start positioning into Bitcoin.
Yeah, cool. I'm just going to jump to my screen and show you very similar thoughts in completely different ways. So we have the previous all-time high here, and then we have what I say is max pain level of this weekly demand zone. So the whole demand zone's there. I'm just looking at the bottom. And then if I drop it down to the daily time frame, for me, all of this was a reaction to this level over here. And this was where essentially we had this high gets taken out and price breaks it and puts this continuation level in. And this is effectively the decision point to break this high. And as you can see, it then price comes down to it, hits it once, bounces off it a second time at the extreme, and then bounces off it at the top and then sends. So this was a really key level, but in terms of supply and demand, it's been exhausted. So I would then look to see the next level down, and I see all of this as a reaction to this. And if you go to the lows here, this is all a reaction to essentially this zone here. And then you've got a clean impulse away from this base. So I would say, although I don't believe although I'm not just going to say it's going to go to 34K, this looks like a bottom to me, like 34 to 36 $1,000, purely because of the price action and the chain of it. So somewhere around here between 45 and 34 is a really nice bottom for me. And also, very simply, if we're going to follow other cycles, it takes us to about 73, 74% from the highs, which is in the territory of looking for a bottom. But again, it's the same thing as what you just said. You've got to look for the certain tells from the market that it wants to bottom, and one of that is seller exhaustion, maybe capitulation, and then some sort of everyone gets super bearish, and then you get that kind of compressed price action when the selling just can't follow through, and then you get the reverse of it. And then for Ethereum, I'm a little bit undecided on it, but I'm not looking to buy Ethereum for the next cycle, to be honest. I might have like a few ETH just for exposure, but I'm not looking to go big. I normally go big all in with my buys. But very simply, we had that 2018 high, which seems like, on one hand, it seems like yesterday, and on the other hand, it seems like a lifetime ago, right? Where price comes up, and then it respects it and puts this low in. You've got this really big wick that you can't see here, and then it breaks it, and then you can see that's the origin then of this trend. Comes down, bounces off of it, and then puts in this big level here, this big zone, which rips away from it, comes back down, tests it, and then you get the all-time high, and then it's coming back down. So I can see it coming back down here to about $1,000. And again, if it kind of capitulates down there and then starts compressing or building, I'd be looking for a long, or I'd be looking to buy some. But I won't have a major exposure to Ethereum just because I think it is a massive shitcoin, and I think Bitcoin is just a bit of a safer bet from my experience.
Yeah. I'd like to add one thing actually to what you've just said. Mm-hmm. I think context matters, right? Yeah. And it's all well and good looking at levels and zones that we might be interested in, or we might think, Ethereum is going to be shit, it's not worth a buy. But really, I think how my trading has evolved, markets generally sell off in two ways. It's either structurally because of fiscal rate, policy rate, some known factor, or unemployment and rising, therefore there's not as much risk appetite in the market, or event-driven, COVID crash, right? Where if you get an aggressive event because now the world or the markets actually realize, hang on a minute, shit, there's going to be some real issues with the supply side of the oil, and the Middle East is just blowing up all their energy infrastructure. That's going to cause a massive spike in probably inflation and global commodity, global energy. And how is that going to then impact markets? So are we going to get an event-driven price action because finally the market gets the hint? Do you remember COVID, when COVID came out in January? It wasn't until March where the market was like, oh shit, yeah, this is not good. It was a very much delayed reaction. And I feel like there still seems to be a level of optimism, and I hope the war does come to some sort of short-term conclusion. But if it is long and drawn out, what does that mean structurally? What does that mean from an event-based system? Does equities and NASDAQ have a big deleveraging event? Because there's so much positioning from the Trump rally that I'm sure there's some hedges now, from the highs. But yeah, for me, it's all about how price comes into it. Let's just say hypothetically, if we went from $2,000 to $1,000 in the next 10 days, I'm buying $1,000 on the backside in the hope that, this is selling capitulation, but I'm buying it for a trade, just like we did in 2022. Look at that balance from 1,000 to 2,000 in a 6 weeks, that's a really good trading opportunity. But I don't think that's a long term. Well, look, I like to buy the right hand side of the V, or the tail side of accumulation is what I like to call it. And where there probably will be a level of base building for, if I do ever want to pick up spot holding. But I'd rather get in and out of the market for a very good 50-60% move than buy a bag of spot, lock up my capital and just, kind of think, oh, when is this fucker going to move? It's been 6 months.
Yeah.
And then you kind of puke your position because you want to chase the next. So yeah, it really depends on your strategy. I think you've just got to have a strategy. What is it that you want to have exposure to? Bitcoin for me is an absolute must. I think it's an asset that's just going to continually go up and towards the right. I don't have any, uncertainties about that. I think this might be one of those periods where could be the last time we ever see Bitcoin down at these levels for the foreseeable future, because I think this takes off in the next 4 to 6 years, and every cycle low we look at, it's when you and I started, Bitcoin was around about 700, 800, 900, and we got the bottom in 3,000, which we never saw coming at 20k, and then we got 69 to 15. Who would have thought 15k would have been on the table? So I think with Bitcoin, it's that type of market where, well, when it moves up, it really rips, and when it moves down, it brings a lot of shock to people about, whoa, what happened to Bitcoin? It's crap. And so you kind of see that in the headlines. I think when you see that again, you just think, you know what, you've got to have the balls and just think, yeah, this is value. I'm buying you. 70% correction has seemed to work. And all right, fair enough. If it drops from 30k to, say, the worst case scenario, let's just say 20k, all right, you can probably add more to your exposure there. The key thing is that I probably will do that, but I'm not going to go all in. The way I'm probably looking to pay is, all right, I'll probably pick up some at 30, I'll pick up some at 20k, maybe 25% of my portfolio. Once I get a base-like structure that I can trade, I'll then move some of that capital over into buy more Bitcoin. And then once Bitcoin is breaking in an uptrend, I'll just add in a lot more size, because now I'm flowing in the direction of an uptrend.
Yeah, it's I totally agree as well. I think there is a potential for the next bottom to be the bottom where you will look at it in 4 or 5 years' time and think it will never be that affordable again. I mean, you could say, okay, 30, 40 grand isn't particularly affordable for most people, but you can get your hands, if you really wanted to get your hands on 30, 40 grand as like someone in their 30s, you could find that kind of money. But in 5 years' time, I think the opportunity will be gone. Which is interesting, because you kind of think that every cycle, and then it comes back down. But this, for me, the way that the whole political scene and the way that the whole world is kind of moving now, it really does seem like this could be the low where you can't see people coming into Bitcoin and being able to afford it. So yeah, I think that's a really good point. But yeah, is it going to be a price action kind of structural drop, or is it going to be an event driven drop? Is also a massive thing. But if you keep it, I keep it quite simple. I just go all in at the lows when, if you see a 75 to 80% drop from the all-time highs, it's kind of like a signal for me, like regardless of the levels on the chart, it's kind of like, right. I mean, I used to have people in our group that their whole strategy was, as soon as Bitcoin drops 50% or 40%, they just buy again. That kind of saw them through. But yeah, it's kind of what I'll be looking at is just, we're down that much, I'm going to buy it.
Yeah, it's interesting. I think, look, for me, I just don't see the point in being bearish on this asset now that it's dropped. Look, we've had 6 consecutive monthly down months, right? 6 consecutive down months, and that's only ever happened once on Bitcoin. Now, I think the big question mark is, look, let's just play devil's advocate. Bitcoin has never been in a recessionary environment. And I think if we do get a recession, you've just got to think, what a brilliant opportunity to buy Bitcoin, because how often does a recession come around? Not very often, every 10, 12 years. And what does that mean for Bitcoin if it does happen, if we do get a recession and global markets are selling off? It'll be very fascinating to see whether Bitcoin holds up, or if it also continues its trajectory lower down, where smashing into 30k, you think, what a brilliant opportunity to pick up some Bitcoin. Who would have thought 30k was on the table from 125? And it again, it's that magic 75% corrective level. So we'll have to see.
Yeah.
I just thought play devil's advocate. I don't know what's going to happen, and I think as traders, Matt, we don't really try to predict where price is going to bounce from or which level it's. We just react based upon the data. What our view is today could change tomorrow or the week after. I think that's the key. The key quality of being a good investor and trader is. Doesn't matter if you had a bias last week and you've had to change it. You've got to change your bias. That's it. This is what this game is about. So
Yeah, 100%. It's I always say to people that regardless of the level that you're at, I don't predict bounces. My style of trading used to be like I would mark this demand zone, I'd mark this supply zone, and then I'd set a pending order on it, and then when it reacts from it, I'm hoping to get in on that. But I've adapted my style over the years to be. This is kind of where I want to do business, and I'm going to watch how the chart moves into it and away from it, and then I'm going to get involved in it. And it's very much the same with my investing. Like I'll mark these kind of key areas, but like it could. Bitcoin has been, touted as the next monetary system, and that's going to be the way to solve the world's inflation problems. But we don't know. Like everything we've seen, whenever there's been a bit of chaos in the world, you haven't seen Bitcoin rip. You've seen it drop. So it's a really interesting thing to say. Yeah, if we go into a very long recession period, is it going to hold up, or is it just going to go sideways, or is it going to drop and like everyone's forgotten about it and everyone's going to say Bitcoin experiment is over? Or it may actually fulfill what everyone kind of got into it for originally, which was to be a new monetary system. And I think a lot of people kind of forget that these days. What I'm just going to do really quickly on Solana, just to cap this section off, and then we'll go into the psychological stuff, because that's really what I wanted to pick your brains about. On the weekly chart for Solana, for me, really simply, is that we had this big drop, and then we go and come down to this base, and it's kind of like a really clean level. Price breaks out of it from this point, and this is the origin of this entire move. And I just think, very simply, I've noticed with my trading over the years that with these origin levels, price always returns to the sender. And then that will also line up with about 75 to 80% drop from the highs. And yeah, I just think the bottom is going to be somewhere around there on Solana. I'm not sure what your thoughts are, but very easily, that was kind of how I look at this.
Would you buy Solana for the long term?
No. Would you?
Only for a cyclical trade. I think that we probably get a move back to 100, 150. I don't know where the lows are. I don't know where the lows are, but I think from a swing perspective, at some point, 2027, 28, it will have that big rally. I don't know if we're going to make a new all-time high. I just feel like, for me, hype is more of an attractive way. I think hype and Bitcoin are the two big. Well, not big, but they're the two main ones that I'm only focusing on. I think consolidated bets and bet big. Consolidate your bets. Don't spread yourself across 20 alts. Go for your highest conviction play and bet more of where your conviction lies, I guess.
Yeah, totally agreed. The hype and Bitcoin is what I'll be looking at for the next cycle as well. Right, let's get on to the next chapter, which is automated trading versus manual trading. So I wanted to pick your brains about this because obviously AI is becoming a very big thing in the trading world and just in the world in general. As someone who's a discretionary trader and a manual trader, and I'm very active in the charts and I actually enjoy that. And people will say to me, well, you need to be doing automated trading and you can have more times off the charts. I actually like being in front of the charts, but I'm seeing the value in needing to have potentially something on a higher time frame where my system, it's very, very if then, and I can plan out multiple scenarios. It's actually very suitable for automated trading. And when we last spoke, just casually, you had talked about kind of going into a deep dive in automated trading. I just wanted to see like how that's looked for you so far. Have you had any success with it? Have you, not in terms of like profitability, but have you had any success with carving out something which you can rely on to be automated for the long term? How does it look, and how accessible is it for people like me who have literally zero programming background? And, you can see from the way I look at the charts, it's all kind of visual. It's very kind of simple. what your thoughts are on that, and would you recommend it for people?
Yeah, first of all, I come from a very strong tech background. I was a software developer for 12, 13 years. I've led engineering teams. So I guess from my position, I transitioned from being a software engineer to a trader. Probably one of the best decisions I've made because of, despite all the highs and lows from an emotional point of view, when you are at your rock bottom lowest, you feel shit. I've been through all the emotions of a trader. And also, I've experienced the highs, but one thing I've managed to do, is achieve a level of consistency, especially, over the last 2, 3 years as a trader. And I think every year I'm just getting better as a discretionary trader. However, I think when we think about discretionary trading, it really does have a degree of variance. It really does have some level of randomness. You're not really truly systematic in your approach, and that's simply because of the human emotion aspect, the psychological aspects. You can never remove it, and in fact, as a trader, you need the psychological, human, emotional aspects of trading to some degree to perform well. But it can also be the one of the root causes of your detriment of being a trader. So it's a really fine balancing act. It's not easy. And when we think about, well, how can we ensure that our trading can perform well? Well, if you really apply a quantitative or statistical method to your trading. So say, for example, Matt, how often as traders do we take a trade? Are we going to put your stop? Oh, I'm just going to put it behind these lows or behind these highs. That actually is a level of randomness, if you really think about it. Can you systematically come up with a method that for whatever trade you take, whatever strategy is, you've already got a predefined way of calculating your stop? The beauty of doing something like that is that over time, you can fine tune those metrics. You've got a sample size of 50, 60 trades where you can say, yeah, I just need to provide slightly more room, or I can actually tighten my stops and get a little bit more size on this. I don't feel you can do that with the random nature of, okay, I'm just going to put out some high or put out some low, because I still do that myself. That's the discretionary nature. That's why it's called discretionary trading. And I want to move away from that because I want to move more towards an environment that I can have a statistical edge. And the second aspect of automated trading is that you're not really looking to trade demand to supply or supply back to demand. It really opens up the mindset in the way in which you're really looking for patterns that repeat in the market, whether it's on a daily basis, an intraday basis. You're looking for inefficiencies that occur in the market that you can exploit, and you can trade over and over and over again, knowing that you've got a very slight edge, but it's a profitable edge. You could have a 40% win rate, but because your losses are contained and small, and when you win, your wins exceed your losses, so you've got positive expectancy, that's all you need. And there's some very, very interesting strategies that I'm playing around with right now. So one thing I've learned is that you can't really just come up with one strategy to trade the market, because the market moves through different volatility regimes. It moves through different contextual regimes. If you've got a moving average system trading on the low time frame in this current environment, you're probably going to get chopped up, right? If you've got a high time frame system to buy Bitcoin, there probably isn't a trigger there because the bands are all pointing down. And so you have to come up with a way where not only are you testing just one single strategy, if you really want to do well as a systematic trader, you've really got to think about having a portfolio of various strategies operating across various markets. And I think what that then gives you is a far more balanced approach to trading, and that you've got this multi-strat portfolio that's running in the background. On some days, your winning strats are doing well, and other strats not so much. But you've got a really nice balance. And then what you're then doing is running Monte Carlo simulations on each individual strategy, but also across the array of strategies, whether it's 10, 12, 14, back test it against the last 10 years of data, forward test it in a demo environment, making sure that it can scale up. So say, for example, you've got a very good strategy with a good profit factor, good Sharpe ratio, Sortino ratio, good expectancy. How much can that scale up in terms of size, over the long run? I mean, that's a problem that you're probably going to have to think about if you are, or if you have a profitable system. But again, it's something that you may want to think about. And then there's the operational efficiency. Like, as traders, many traders will just market in and market out, especially in crypto where the fees are quite high. How much how much of that is actually burning into your profitability, your bottom line? Whereas if you can be more efficient in your trade execution because you're using maybe a VWAP chase algorithm that executes on limits only. So there's so much to think about when it comes to algorithmic trading, or at least trying to develop trading strategies. It really, I would say, helps you think about trading from a completely different perspective as opposed to supply to demand, demand to supply. It really gives you ways where you realize, actually, there's a trade setup that I see happen once or twice a week on the SPX. And if I shared a setup with you that's only got half an hour, most people would turn away from that because, you're only going to get half an hour. But what if I said that, well, this happens consistently week in, week out, and it's something that I can repeat for over 100 trades, and I can measure the performance of that. That's all it takes. You just need a slight definitive edge that you can repeat over 100 trades, 1,000 trades, and that will compound over time. So long story short, I think it's far more of a qualitative and quantitative approach, and I think it just removes the human emotional aspects out of the trading as well.
Yeah, I think the daunting thing for someone like me is that I would have to learn a whole new way of trading, and obviously that takes a lot of time. Where I look at something which I've developed over the past 10 years, and although where I'm at now wasn't like, hey, 10 years ago, I'm looking at this and had this structure of what I'm going to do. It's just I've just kind of landed here through just years of experience and years of looking at patterns, years of just watching the charts move, years of trial and error. The problem I have with it is, and you've actually just kind of nailed it with, like, kind of one of the issues I had with it was that you need to have a portfolio of different automated strategies. And I think the person I've seen doing that the best, I'm not saying like he is the best, but in terms of my following, the person I've seen doing that the best is Kieran Duff. And when I've seen what he's doing, he's got like 10, 20 different things going on. I'm like, what the hell, man? And as someone who kind of wants to get into it, because for me, it makes sense having things on the side. I mean, I love trading. I love sitting in front of the charts, and I like being involved in it. But it feels like I'm missing something by not having this in my arsenal, so to speak. Is it something that, like, I've seen obviously a lot of people using AI to help create these strategies? Is it as easy as that, as being able to say, like, I've got this kind of base idea of how to enter the market and how to run trades, and kind of where to look, and using AI to kind of assist in creating those strategies? Is it as simple as that, or is it, it is going to take years long process? You're going to have a background in, because when I had a mentor about three and a bit years ago, and anyone who kind of knows me from the BTG days and my social media profiles was that I've always kind of used terminology. Obviously, I'd use readthemarket.com. So you got supply zones, demand zones, you had FTRs, you had all this kind of stuff. And he kind of helped me to strip away all of that language and make it really objective. And so that if I'm teaching someone, for example, if I've got this document and I'm giving it to someone, I'm not saying, right, when you see a supply zone, you do this, because they're not going to know what a supply zone is. So it helped me kind of annotate what I'm seeing on the charts with completely objective language. But then it put my head, which has never been in this kind of headspace before, in the if-then scenario kind of way to work. Whereas before, I'd just been like, here's a demand zone, I'm just going to hit it. But then, you take into consideration like higher highs, you take into consideration the momentum, you take into consideration, like you said before, is it a price structure movement? Is it a news-driven event? There's so many different things to think about. And I think on the core of my strategies, I can explain extremely well. But in terms of getting that coded and getting a bot or something to automate it, I'm not really sure how that works, and like if it's even feasible, like, do I need to have a bit more of a background in coding? to understand how to develop these things, or do you see products and a new market evolving where people can take this kind of idea that they've got and then apply it to, or give it to someone to automate for them?
Right. It's actually easier than you think, and I think what people don't realize is that they must think that they've got to be some sort of quantitative algorithmic developer. That's not actually the case. I think if there are systems out there that have a black box approach to developing strategies, and it's more like it's a wizard. So it's a wizard where, just think of a flow chart. If you understand the logic of a flow chart, and there's some software bench that allows you to drop a decision tree and construct your own rules engine, and it magically writes the code behind, then those systems exist, which are very good. And I think Kieran's been a fantastic proponent of those types of systems where he's got a strategy idea. And again, he's somebody like you've mentioned, for me, he's been a massive influence and really kind of got my eyebrows raised. Hang on a minute, I should actually take a look into this more, because it's fascinating to see somebody do really well in the short space of time that he has picked it up. It's like you and me. He came from a discretionary trading background, and I think with you'd have to talk about his decisions as to why he moved over into, well, there's two things you got to think about. Well, one is creating a strategy, and the second part is automation. So what is it? Even though you may not know coding, you can still use a strategy indicator base, which is going to help you with your decision making as a discretionary trader. Or you can take it a level further, where you can look to start automating some of those strategies, or you want to get into automation. So when you're getting into automation, it's a completely different mindset in as to how you have to think about markets. And yes, you do have to do some background reading, but in all honesty, the barrier to entry is relatively low nowadays. And I think if you come from a trading background, which you do, I don't think it's going to take long for you to actually understand, well, here's a software suite, and I know what an RSI is, I know what a MACD is, I know what a stochastic is, I know what a VWAP is, I know what moving averages are. Sometimes that's all you need just to get up and running. And you can then play around on lower time frames, higher time frames. You might have a high time frame trading strategy, which is reliant upon buy spot in this condition and hold it for the next however many months until price loses or has a drawdown of 5% as a swing trader, which is fairly good, right? If we're talking about multi-month holds. I'm a big fan of somebody called Nick Raj and his book Unholy Grails. He's got a monthly rebalancing trading system. He rebalances his trades once a month, and he just sticks to a very, very, very high time frame monthly strategy. And he even mentioned that he could automate it. And I could be wrong on this, but I do recall him saying he could automate it, but for the overhead required to automate that, it's just far much easier to rebalance it on the first of each month, or the first trading day of each month, so that, okay, here's a new set of trades that is going to switch out. If he's got 10 positions, he's going to take off 5 and put the next 5 in place, because from a weighted average, they're actually performing better. So he's looking to trade momentum. That's a momentum-based strategy on equities on a monthly time frame. So sometimes it is a simple system that can do really well. And I think the one common mistake is that we all like to over-engineer solutions. We all like to, work in a mindset where we think, high IQ, we've really got to think above and beyond to be successful. Not really. Just do the simple things well. And make sure that there's a positive level of expectancy. That's all you need is keep it simple, do one thing, do it really well, and refine it over time. And what might be something that generates 10, 12% return on equity a year, after 3-4 years in the right environment, it could be yielding 20, 30% because you've improved your execution efficiency. You've added more filters to the strategy, which help refine its success. So it's all about continuous development of a given set of strategies as part of a portfolio. And I think the one caveat is that if you're looking for a strategy that's going to give you 200-300% returns, good luck. But if you want to be more realistic in the sense where I just want a strategy that's going to return 20% on average, which is fairly respectable from professional standards. You know, you look at some of these funds out there, wealth management funds that not guarantee, but they try to offer you 10-15% return on equity, year-on-year growth compounded, inflation protected. Well, that's phenomenal, because where else are you going to get that? You're going to park your money in government bonds and look for 4% return on capital? Fine. Are you going to buy a property and put it on rent? Well, that's going to cost a lot of money in terms of upfront purchasing the property. Then you've got to refurbish it, and then you're looking for anywhere between 8 to 10% yield, if you're lucky. And then you've got to pay, you know, whatever taxes on there, and then you've got to refurb the property again in 5 years' time because your tenants have kind of trashed the place. So, you know, it's you've just got to be realistic and just think long term. Don't think, just like Bitcoin or altcoins, I can plow, you know, my life savings into hype, and I hope it does a 10x. Well, what if it doesn't? As opposed to working towards, over the next 10 years, if I can just yield 20% a year on year growth, and this system is going to allow me to start a scale in capital where I can scale my size, it's going to be worth it. No, yes, it might not be worth it if you're starting off on a very small account, but then there's nothing to stop you. That if you can develop a strategy that's proven to be profitable, when I say strategy, I'm talking about a multi-portfolio strategy. And if you've shown very good returns over a 2-year period, and it can scale in size, whereby you can manage $10 million of capital, take it, scale it up, get your licenses, or find platforms that allow contributions towards outside investors in your strategy through some third-party platform. So there's so many options available there.
Yeah, so it sounds like keep it as simple as possible and keep your expectations like. I mean, it's one of the big things for people in crypto, especially, is keeping expectations low, because we're all kind of used to, right, where's my next 10,000% going to come from? Would you, just last question on this point, if someone was newish to trading, or maybe in their first year or two, and they came to you and said, hey, I don't know which path to go down. Either I stay as manual trading and I like being active on the charts and developing my skill set there, or do you recommend I automate something and figure that out? Because the success rate with trading is extremely poor, is extremely low. And do you think that with automated strategies, because again, you can keep it very simple, someone's success, if you start, you know, especially when I first started out, I had like fuck all money. And if you're saying like 10-15% of, you know, £1,000 account, £5,000 account year on year, it's not that great. You've got to have a huge amount of patience, and you've got to also have that mindset where you're able to manage small amounts of money as if it is large amounts of money, and you've got to be able to respect that. Do you think that more people are going to have success with automated strategies, and maybe that's a path more people should go down versus manual trading? Or do you think it's kind of hand in hand, really, and you have to kind of keep like building the skill set up for both at the same time?
Trading is very fucking hard. As a discretion trader, it is really fucking hard. And if I'm not bullshitting, and I don't want to bullshit anybody, I think the likes of you and I, we were lucky to an extent. We got into Bitcoin when it was relatively cheap. We got into altcoins when altcoins would go absolutely berserk. And I sometimes look back and think, if it wasn't for those periods, would I be in the position that I'm in today, where having been quite profitable because of the past has allowed me to focus more on my trading game, where now I've actually excelled as a trader. I didn't have that luxury. I would never have had that luxury. If I just came to the market and traded FX for the first 5-6 years without any altcoins, I'm not sure I'd be in the position that I'm in. But having said that, part of being a good trader is, and we've seen this happen in crypto quite often, how often do we see people make a shitload of money, but they piss it all away within 6 months to a year because they've just blown out, or they started leverage trading? Well, that was a bit foolish as well, because you've done the hard work of trying to make money, but you've now got to do even the harder work, which is how to preserve capital, which is the one reason I think that why most traders fail, because everybody's a genius on the way up, but really, you know, the old adage of like, when the tide goes out, you can see who's been swimming naked, and the market will expose you. I got exposed in 2018 as a trader. I am somebody who took something like 6, 7, 8 Bitcoin to over 100, and I got smashed back down to 30 Bitcoin because one, I held onto my altcoins, and two, I started margin trading a bunch, because I thought, the market's going down, the alt's going up, let me trade this, and you kind of get your ass handed to you. And then you got to sit back and think, shit, I can't continue like this. I need to learn how to stop losing money. That's your first point of call. Learn about risk management. Learn that actually being a good loser matters. Not being a bad loser, but actually being a good loser is going to take you a very long way. I say it like this, Matt, you can take 1,000 trades, and if you've got very good risk management and a half decent expectancy, you're probably going to do well in this career. If you take one bad loss, one huge loss out of those 1,000 trades, game over. Forget about it. You can't afford to fuck up. It just takes one bad positioning, one bad trade, one bad event, like we saw 1010. How many times do we see it in the crypto space where every 6 to 9 months, there's a massive deleveraging event? Every time, every 9, 12 months, 6 months, it happens every year. And when it happens, you kind of see their emotions on the timeline. You kind of hear stories about people blowing out, and that's just the reality.
It's brutal. I kind of think it's a bit of a rite of passage as well, because like what you were saying, I've had my own instances where I've made a lot of cash, and then you get really cocky, even if you've had like a profitable few years or something, and you've not got lucky, but you've actually done that with skill, and you've done that with proper discipline, you've done that with the proper mentality. But dude, like when things turn down, like in the previous cycle, I sold out too early. I still sold out at a pretty good level, having bought in really early, obviously, but not catching the top, and it really messes with your head, which is why I think more people are probably suited to potentially looking down at something which can take away all of that emotion from them. Because when you talk about strategy, you're able to see. This is like my impression of it, because I obviously haven't looked into it. But if you're building an automated strategy, you're going to have to calculate into that how much drawdown the strategy is going to have to endure. Whereas as a discretionary trader, or as someone who's just like doing all their trading manually, when you build your system, you're not going to consider that. Like, I mean, obviously there'll be outliers, and there'll be like, it's not it's not a hard and fast rule for everyone, but in general, the majority of people, especially coming from a retail background, we're not going to look at this and go, I've just picked up something from ICT and I've developed this strategy with order blocks or supply and demand or whatever, and then suddenly think about, well, this is good, but how much drawdown am I going to have to endure over the next 12 months with it? And am I going to be able to keep my head when I've got that drawdown? Whereas if you've got an automated strategy, I imagine it's all part of the process, because you've calculated that into the strategy, and you're not effectively managing those positions. Like, you're not watching the chart go up and down, and you're not watching it hit your stop loss and you take profit. So I think more people probably would be suited to that kind of, that's my impression of automated trading anyway.
I would say one thing. In any walk of life, you have to understand the domain of what you're operating in, right? If I'm a software developer, I need to learn about software engineering principles. If I'm a trader, I've got to be able to understand, well, what is an RSI? What is a MACD? What is expectancy? What's the Sharpe ratio? How do I calculate? How do I read a chart? So there is a level of learning required. You can't just rock up and say, I'm going to become an algorithmic trader. I don't know what any of this means, but yeah, let me just see. But what are you going to put together if you don't understand the domain language? You've got to understand the domain of what you're operating, how markets function. What does microstructure mean? What does positioning mean? How can you find out how do you know what an order book is? How do you know what L2 is? How do you know what a footprint is? How do you know about all the various metrics? So you've got to understand the metrics and the indicators that you can potentially use, or the stochastic methodologies you can apply to algorithmic trading. So it does require a level of 1 to 2 years of actually understanding the domain. Just like how you can't just rock up and say, today I'm going to become a heart surgeon. You've got to put in the hard work, and you've got to go through the training required and the studying required. And trading for me is just one of those professions where if you're going to rock up with a lazy attitude and you think you can print money, you might do well on a meme coin cycle, but that's not really trading. That's just purely gambling, speculative. You try doing that over 100 trades for the next 5 years, good luck. You do it once or twice, well played. Congratulations. Take your money and run. Maybe come back in the next cycle and see if you can do it again without losing all your money. If you made your money to run. But the one thing I will say, I've got my equity curve. I don't know if the users can see that.
Yeah,
but I want to talk about this because part of maturing as a trader, there's a reason why I say that you have to understand context. I know that I perform really well in a volatile environment. When prices whipping around, going from range low to range higher trending, that's when I put my foot down. When I look at the price action of the last 6, 7, 8 weeks, okay, this is my equity curve. Look how much sideways it's going, and then I take a trade. Sideways, I take a small loss. Sideways, I get another win. A few small losses, another win, sideways. Why? Because I recognize that when I look at the current environment on Bitcoin, this isn't for me. I'm not interested. I'm not going to excel. This isn't where my edge is. But when there's an uptick in volatility, if we trade the extremes of February's highs and lows, or the equity curve that you can see here from September, October, November through to December, that's where I've made the most amount of money, because this, well, not this chart, this is Solana, or sorry, we were seeing the chart on Solana, but what have I recognized? That I trade volatility extremely well. When there's an uptick in volatility, that's when I shine the best. When the market is very, very choppy, sideways action, isn't really doing a great deal, news-based events are going to push me offside, I'll step away. There's nothing for me to really gauge from. I'm not going to exhaust my energy trying to trade a market where I may have some edge, but not a great degree of edge compared to another contextual environment.
Yeah, I think that's the key with success with trading, really, isn't it? It's not the thing that gets taught because it's not that shiny, but it's learning to not trade. It's learning to when to step back, because realistically, the same as what you just said earlier, like you can make money on pretty much any cycle on crypto, because you've got 3 years of up only, basically. Obviously you have like periods of consolidation and stuff, but everyone can make money. But it's about keeping the money and growing the money rather than giving it all back. And it's being able to recognize when those periods, like what we're in now for the past 6, 7 weeks, if you've got an edge, and I'm like you, I've got a lot of my profits come from very volatile markets and trends. And when things stop moving and they kind of go sideways, I've been prone to giving a lot of my gains back. And you have to go through that in order to understand the problem that you've got, in order to not have it again in the future. And your equity curve is like a really nice example of that.
But here's the thing: if I said to people I've got a 40% win rate, people are going to say, "Oh, that's shit." I thought you're really good at trading. Well, I am, because I'm very good at taking small losses. Yeah. That for me is a very good trader. And then when the wins come in, they look after themselves. And secondly, I don't round trip majority of my profit. So it's. And then, like I said, Will Hunting, WMD4X, said it best, and I'll never forget what he said, that no matter how good your strategy is, the strategy isn't the problem. It's you as an individual who can't apply the strategy in the right environment. That's what's going to cause that's what's going to cause you to fall down in trading, or that's what's going to hold you back as a trader, because you've spent all this time mastering the strategy, but you don't know where to apply it or when to apply it. And this equity curve is kind of representative of that for me, that I don't really want to trade this market. It's recognizing when you want to trade and when to step away and sit in your hands. Yeah. And you will get. I'm a big believer in Pareto's principle, 80-20. 80% of your gains come in about 20% of your trades. The other 80% you're just churning over small singles. You take a few losses, you win a few, a lot of sideways but slow grinding up or grinding down, and that's it. But then you get these quick spikes in P&L growth, equity growth, because you know when to put your foot down, essentially.
Yeah. Shout out Will Hunting. I think he's coming on next week. I actually spoke to Tom Dante a few months ago for the first time, and he kind of opened my eyes, because my perception of like real pro traders like him was that they're going all year, like constantly. And he told me, no, actually, I will take a month off if I need to. And my perception was like, oh, I thought like the institutional guys are just on it all the time, but yeah, that wasn't to be. But this will kind of segue into the last section, actually, and that is about the pro trader mindset. So just to cap things off, my battery's going to die on my camera as well, so I'm probably going to disappear in a moment. So it's just going to be our dulcet tones. But we had spoken last year when we started reconnecting, and I kind of say as a joke to myself that I'm a pro retail trader. I wouldn't call myself a pro trader, particularly having a bit more exposure to people nowadays who work in prop or work in funds, and you can really see like the difference in terminology. You can see the difference in approach, and you can see the difference in just the way that people act on the charts and their overall outlook. My goal as a trader has always been to move to a professional environment. That's always been what I've wanted to do ever since I first heard of trading. It's very difficult to replicate that as a retail trader, because you don't have a support network behind you. You've just got yourself. You've got to do enough research as well into understanding different things that pro traders pay attention to. And one of the things that we spoke about, which we kind of had a little bit of a laugh about last year, was Kalmar. And we've both been guilty of it as well. And I think you have to understand it, is that, you know, having massive swings in P&L, even though I always say that the end goal of trading is just to make money, if you want to treat it professionally, you have to take into consideration things like this, where if you've got a 60% drawdown, but you're 50% up, no pro firm is going to ever touch you. You're not even going to get through the door. So I'm kind of, that's my long-term goal, is to move into that type of environment. My personal life doesn't dictate that I can do that just yet, but I'm working on it, as we've discussed quite a lot. What's your kind of take on how retail traders neglect that side of their strategy, and that it contributes to their downfall because they're not looking at things that pro traders are looking at? And yeah, I guess that's kind of how I wanted to introduce this subject. And is it something you still want to do, or is, you want to stay within your own means and trade on your own books?
I think you're right in the sense where I call it pro retail. I don't think I would class myself as a professional trader. I would certainly say pro retail is the right vocabulary. That's kind of where I think you and I fit, because we could probably spend the next 4 hours talking about professional trading. And I think what I know now, if I had known that when I started, my approach to trading would have been absolutely different, without a shadow of a doubt. What I know now and the mindset that is required to think like a professional, it just opens your eyes as to what trading is. None of this bullshit, oh yeah, if I've made 400%, 500%, 600% return and you can do that every single year, it's not going to happen. It's, unless you're a once in a generational trader like Kolamagi, you're right. It's probably not going to happen unless you've got a really phenomenal timing of the market and you've stuck around long enough to make it count. And I think that's why again, it comes back to context. When those opportunities come, you just know when to put your foot down. And that isn't going to happen overnight. It's not going to happen in 3-4 years. It happens with experience. And it's exactly what you said. I think crypto has this perception of, oh, look, he's made so much money. But when you look at the actual equity swings and drawdowns, 30, 40, 50% drawdown is not good. It's only a matter of time before you're going to blow up. And so one of the key things that I've really tried to focus on is, on a month-on-month basis, I really like to stick to tight margins, that my drawdown is never more than 5%. Over the last 6 months, my max drawdown was 3.1%. And I know that if I can continue with that type of risk management, that's something that I can scale in size. I'm happy to put more money into my account, knowing that I'm very, very, very well defined with my risk management. But if you've got a portfolio or trading an account where every month, you're making 30-40%, but you're having 10-15% drawdowns in a week, and then over the year your max drawdown was 40%, but you managed to recover your account and you've probably doubled your account, nobody's going to give you money to trade. So why would you give yourself extra capital to trade, knowing that you're only one or two bad trades away from going into 70-80% drawdown? And that then becomes very, very difficult to come back from. It requires some serious discipline. So you've kind of got to earn the right to size up in terms of capital, because if you don't, then you shouldn't be trading. And I wish I knew that from the very early stages of my career. It's taken me a lot of pain. It's taken me a lot longer, I guess, than perhaps if I had a structured, progressive way of understanding what I need to do. And the one thing I would say is that I think it amazes me how after 2-3 years, many individuals, even after 4 or 5 years, they don't understand what it takes to become a professional trader. It's often glamorized as retail trading, and when you really get to the crux of it, just look at what it actually takes to become a professional trader. You've all got access to ChatGPT, you've all got access to various LLMs. Just play around. Ask it what does it require, and what type of returns do I need to achieve, and what type of risk management performance do I need to have as a trader to possibly be considered for a position at a prop firm. Not these bucket prop shops, FTMO bullshit challenges that we see, like an actual prop firm.
I mean, they're more like games, though, aren't they? That I look at those. It's good. I think overall it's a good thing for the trading space to have those, because one of the problems that we would have had 10 plus years ago when we first came in was getting access to capital. Like when I first started trading with Tickmill, you had to deposit a minimum of 25 grand. And as a 23, 24 year old, I did not have access to that kind of money. So I think that's a good side of it, but it has massively skewed what people think trading is. And I've got payouts, so now I can trade for whatever firm or whatever the case is. But it kind of goes back to what you were saying then. Like, yeah, if you knew what was required many years ago, you would have changed course and looked at things into a little bit more detail. And that's kind of the problem we have as retail traders, is that we don't have that support network. We don't have like a risk manager. We don't have peers that we can be able to speak to, unless we obviously find them out online. And you don't know if people are LARPing. You don't know if people are genuine. You kind of have to listen to each other's experience and draw your own conclusions from that. But same way for me, like the thing that I had a big problem with was round tripping trades, having higher drawdowns than anyone would bear to touch, and then being able to recover that. And I used to think like, oh, I've made like 70% this year on my account. Like if I just go show this to someone, people are going to flock to me and throw money at me. But then I learned about these things. I was like, oh shit, no one's going to want to touch me if I was like 70% down at one point.
Yeah.
What kind of sort of methods did you put in place to be able to change your trading? Because for me, like one of the best things that I did was read Best Loser Wins and sort of changed the way I looked at trading, limiting my trades per day, limiting my risk, and putting certain, there goes my camera, putting certain things in place to kind of limit my negative side of my trading and like all my weaknesses. Like what did you do anything specific to change, or was it, once you saw that what it actually takes to be a pro trader, was it like a mindset shift?
It was everything, process, methodology, risk management, position sizing, how to calculate position sizing, which markets to trade, volatility regimes, through to mental discipline, emotional discipline. How do I track it? How do I record it? How do I eat, breathe, live, sleep trading? And I can say for certain, most of the work isn't on the chart. It's actually outside of the chart. And the one question I have to anybody listening to this stream is that, can you truthfully sit down, write your strategy out, just one strategy along with your execution parameters, why you're looking to execute the trade at the point of execution, and share that with your trader friend. Because if you can't, then what are you trading? It's randomness. It's not systematic. It's not a strategy. You're better off going to a casino with your money, or just going to, wherever, slot machine, because you're going to piss your money away at some point. And that's why that old saying, 90% of traders lose 90% of their capital in the first 90 days of trading. The one thing I will say, though, I could really talk about this, and I actually did do a very in-depth talk about this a while back. I don't know if anybody wants it, but I'm happy to share. I did a podcast on the In Silico terminal a while ago. You can, I don't know if you can potentially share that, Matt, or probably not.
On your screen, you mean?
Yeah, but basically, on my screen, yeah. So I did it was a 1 hour, 40-minute podcast back in, it was December. And really, I talked about the entire trading process from my own journey and what I went through. And I've given like a lot of slides and decks as to the various stages, from the failure rate through to defining edge, what is expectancy, what does my trading process look like. Here's a kind of a snapshot of that. It's about understanding yourself, your psychology, your routine, your risk management, trading proficiency, strategy testing, execution. You've really got to dig deep into each one of these to fully understand yourself as a trader. And it wasn't until I did this that I actually felt I had a level of control and purpose in trading. Anything before that was purely randomness. There was no systematic approach. Even knowing your A game, your B game, your C game, even your mental game. What's you at your best? What's you at your half best? What's you at your worst? And when you start exhibiting this in your trading, you'll know exactly why you went wrong if you truly reflect upon your trades. And I'll say one last thing. I keep saying it in my own streams. The best paid group or the best trading group that you can have is your journal, yourself. Your self-reflection. And if we think about trading, it is a form of professional sports, right? And I'm going to wrap up on this final note. I've said it again, I'm just going to repeat myself, but if you're a professional boxer and you want to become a world champion, it's a case of how often do boxers, after a fight, go back to the drawing board and review their tape of their last fight and find weaknesses and strengths in their game before they go on for their next fight, and they prep and they train. Trading is the same. However, in trading, you've got a level playing field. You can enter and compete against the best of the best in this space. You can compete against Citadel. You can compete against some of the top firms. You are all trading in the same arena, right? Whereas boxing, for you to get to a professional level, you are not going to spend 6 months in the boxing gym and think that you're going to fight a top tier boxer and you're going to win. No chance. You're probably going to get knocked out. And trading is the same. There's no way that you can step into this after 3 to 6 months and really think that day in, day out, you're going to perform against the best and make money. It's not going to happen. So you really have to spend a lot of time working on yourself, developing yourself, because unlike boxing where you've got to earn your way to a professional fight, trading opens its doors for you. It'll chew you up and spit you back out. And you'll be emotionally fatigued, emotionally wrecked, because you've just now pissed away a lot of money, and you come back in with more capital, and the same is going to happen again and again. You're not really going to see any change. And I'm strictly talking about trading. That do you have a system in place that allows you to trade for the next 1,000 trades, and you can look back and think, you know what, I'm actually pleased with my performance. I know where I need to improve, as opposed to just complete randomness.
Very well said, mate. Yeah, and to add to that, that very last point, most people don't even have the foresight to look ahead to their next 1,000 trades. I didn't want to interrupt you while you were on your flow then, but the screen wasn't up for the podcast that you're talking about. It's still showing Trading View. I don't know if you wanted to show that on another window or something, but yeah, I didn't get to see that. But very cool, man. That was great. I really enjoyed the talk about automated trading, especially as someone that's kind of at the beginning of stages of exploring that. The pro trader mindset is something I've been trying to replicate for a number of years. And when I was single, when I was, I thought the stream had ended, but it's you're sharing screen. When I was single, when I was living alone, I found it very easy to build a lifestyle around. Okay, there's the podcast. I found it very easy to build a lifestyle around being able to follow my rules consistently, having the right mindset to get to the charts each day and be at a level playing field, rather than having a kid now and having like a bunch of other stuff in life happening, to have a consistent mindset and consistent emotional state in order to execute consistently. And I think that's the thing that is very, very difficult for retail traders, because if you're in a pro trader environment, you've got someone that kind of knows you inside out, kind of knows what you're doing inside out, and acts as kind of like an overseer that says like, hey, you need to step back a little bit, or what are you doing? Why are you not pushing harder? This is like the perfect environment for you. That's what we really struggle with, because we don't have that. But there are definitely systems in place that you can build to limit the downsides of being a retail trader. But it takes a lot of discipline, it takes a lot of work, it takes a lot of years, it takes a lot of instances where you've done your ass and you've round tripped and you've lost loads of money. It's almost like you're living in the house that you're building whilst you're building it, and you're going to build walls and they're going to crumble down, and then you're going to learn why they crumbled down, then you're going to build that wall again. That's kind of how I liken trading. But yeah, anyway, man, it's been great chatting to you. It's been great catching up. And we've kind of gone over by some stretch of what we had intended. I kind of thought we would, because we always do that, don't we, when we talk?
Yeah, it's
we'd love
good
to do it again, man.
Yeah, absolutely. We can probably go over some of our processes that we've put in place over the years.
Yeah, that'd be great. Yeah, like get that all prepared and show that off. That'd be awesome.
Thank you for having me on, and thank you to the audience. If ever there's any questions, please bombard Matt. Send him all your DMs. Don't message me. Just message him. He'll probably reply. I won't.
All right, cheers, brother. You have a good rest of the evening, and we'll catch up when we next speak.
Yeah, good night.
Right. Cheers, everybody. All right, take care. Bye-bye.